Equity markets seem to be in the midst of a perfect storm, displaying an extreme volatility. The concerns related to inflationary pressure and policy tightening by global central banks seem to have got exacerbated in the past couple of months, especially with the long-drawn geopolitical crisis in Europe and the fresh wave of COVID-19 in China. Over the past month, the benchmark S&P BSE Sensex and the Nifty 50 indices have declined over 5% each, while the BSE Mid-Cap Index has cracked over 8%. The BSE Small Cap Index, on the other hand, has plunged nearly 10%. Such a slide in the indices came as investors gauged the spillover effects of the macro headwinds such as inflation, margin pressure across sectors, and the cautious commentaries by various corporates. According to analysts, there are increasing concerns building up on the possibility of a stagflationary scenario, which, coupled with rising bond yields, does not bode well for equities as an asset class. The rising dollar index and the persistent selling by the FIIs are also not helping the cause. Given these, Milind Muchala of Julius Baer India sees markets continuing to remain influenced by incremental news flows related to central bank actions, especially the US Fed, and inflationary trends. All intraday recoveries are getting sold off, and various technical levels are getting broken, making the markets more nervous. While there could be some technical pullbacks, the markets will continue to remain influenced by incremental news flows related to central bank actions and inflationary trends in the short term. Muchala also pointed out that FIIs seem to be holding one of the lowest net long positions in the recent times in the FNO segment, which could trigger some short covering in the case of markets. No wonder then that benchmark indices have gained close to 3% so far this week, as against 4% rally in broader indices. As broader indices see a sharper recovery after a steep knock, should one consider nibbling in the space? According to analysts, while investors dumped mid and small cap stocks as the markets turned choppy, these two segments could see good investor interest from a medium to long-term perspective.
I believe these cycles are common in the economy and markets, and all these cycles proven to be short-lived, or maximum they last for 8 months to 1 year. So I believe that the valuations have corrected. Sensex itself now trading at 20p on trailing basis, and a lot of individual small caps have corrected 30, 40, some of them even 50%. So as I've been always saying, this is the best time to rebuild wealth over the next 1 to 3 years. Within 3 months or so, the small cap will start performing very well.
Sujan Hajra of Anand Rathi, on the other hand, believes that the negatives have been overestimated by the markets.
That we also believe that all the three major calls, that is on growth, GDP growth, inflation, as well as the pace of monetary tightening, at this moment we are overestimating. The actual growth slowdown, the actual inflation, average inflation level, and the actual monetary pace of monetary tightening will be lower than what is being expected now. What is being expected right now. Consequently, we think during some point of time beyond the next 3 to 6 months, central banks will start slowing down the policy tightening. Inflation will turn around and start softening more than expected, and there will be some level of growth slowdown, which will make the policies, whether fiscal policy and other policies, more accommodative. Clearly, that is something which is positive for the equity market. So despite our concern for the near term, we remain positive on 12-month outlook for equities.
Therefore, as expectations mount that mid and small caps may outperform their large cap peers over the next 1 to 2 years, Chokalingam of Economics Research suggests that investors should check the quality of the management and the guidance they give. Secondly, investors should pick stocks with 5 to 10 years of listing history. He says one must analyze the balance sheet's strength before investing. In a nutshell, mid and small caps will likely outperform over the next 1 to 2 years as retail investors throng the markets in search of better returns, and as macro headwinds subside over the next couple of quarters. On Thursday, markets will track global cues, weekly FNO expiry, and March quarter results. Besides, initial public offering of Paradeep Phosphates and Ethos will also be eyed.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.